It's time now for today's strategy session. Today, we're honing in on the defensive trade. The 10-year yield dropping today after seeing its biggest three-day jump since 2001 amid Trump's growing trade war. So, big question, is now time to buy into bonds, or are there more losses ahead? Joining us now, we've got Gene Goldman, Cetera Financial Group CIO. Great to have you here with us in studio. Let's just start with that question. Sure. What is the decision tree around whether or not to buy into bonds right now?
Sure. I think, first of all, thanks for having me back on your show. I think the key thing is, while we had a great day yesterday in the markets, we saw a phenomenal run, keep in mind, though, there's still a lot of uncertainties in terms of the trade war. Yes, one of the tail risks came off of tariffs, but we still have, a lot of countries that we still need to negotiate with. We still have the fact that tariffs rise faster than they fall. We still have a lot of non-tariff barriers. So market volatility is going to be here for a while. A key way to mitigate against market volatility, in addition to liquid alternatives, will be treasuries. And we do think treasuries are still a good basis for defensive positioning. But with that said, though, inflation is picking up. So we do think yields are going to move somewhat higher despite their defensive characteristics. So I know it sounds like I'm saying on both sides of the equation, but clear, inflation is still going to rise and it's going to push higher. The one thing that changes the story, it's not our base case. We have a recession, the Fed comes in, cuts rates 4 or 5 times pretty quickly, inflation comes down. We just don't see that. Our base case is still a Fed 1 or maybe 2 rate cuts in 2025.
It feels like bond investors are coming in because they feel that the Fed is not going to. Like, there's bond vigilante activity potentially happening under the hood here. Does that play into how you think about advising people to own treasuries across the yield curve? Does that play into whether or not it's a safe asset for investors right now?
Yeah, we still think yields are going to move up a little bit, but we still think it's a very safe asset. We're very apprehensive of high yield. High yield spreads are widening, clearly signs of uncertainty. They're still well below long-term averages, but treasuries, again, offer that ballast in the portfolio. Simple example, you go back to 2008. One of the things that only did well, that mitigated against volatility, were treasuries. And with all this said, though, let's say the tariff issue gets settled, let's say, fingers crossed, but let's say it gets settled. The key thing to think about is that treasuries are pretty attractive. We're about 2% over inflation. We have a lot of retail buying of treasuries. We have a lot of foreign investors buying treasuries. Like 27% of treasuries are being bought by foreign investors. There's still significant demand. And if I'm going to get 2% over inflation on treasury yields on a 10-year, it's an opportunity.
And so with that in mind here, what side of, and you started to answer that question, the side of the duration that you should be comfortable owning treasuries at this point?
Sure. We've been incrementally raising duration in our portfolio. So let's say the Barclays Ag has a duration of about, let's just say 6. So a few years ago, we were down to about 3 or 4, and we've been incrementally raising it now. So now where we are right now, we're pretty close to 6, maybe like 5.5 in terms. So we're pretty close. We think duration, the ability to lock in that yield to get that coupon, is an opportunity.
I want to move off of bonds and get some other picks from you.
Sure.
Talk to me about how you're viewing gold right now.
Gold. So gold's interesting. I think gold is such a defensive characteristic, but you also have to consider you need a weaker dollar to really benefit gold. I know gold is defensive.
We got that today.
Yeah, finally. Yeah. But keep in mind, though, countries that raise tariffs, usually their currency appreciates. And we haven't really seen it. We've seen a little mix back and forth. So gold, it's a good defensive characteristic, but I'm not really sold on gold. I think gold has run up too much, too fast, too quickly. So we're not really excited about gold. I do think if tariffs get settled a bit more, I would be more playing silver. Silver and gold are both 2 commodities, very precious metals. But as we all know, silver is everything. Silver is in this desk. Silver is everything. It has much more manufacturing capabilities. It's a good beta play if things get optimistic. And we are optimistic that stocks are going to be higher today by year end relative to where they are today.
And so with that in mind, does a 60-40 portfolio aptly position investors for what we've heard of as an unprecedented type of arena that we've entered into right now?
Everything's unprecedented. It's all new. This whole world. I mean, our base case coming into 2025 was a correction, some moderation in growth. The Fed a little bit on the sidelines more. This is very unprecedented right now. This is a binary trade. It's tariffs, yes, tariffs, no. So with that in mind, though, even a 60-40 portfolio still works, but I'd add a little bit of stuff that's undervalued lately. Small caps, international, take advantage of that. And liquid alternatives. We are big believers in liquid alternatives, those things that zig when the rest of the markets are zagging. Because again, the markets are terrified. And again, markets want this volatile driver.
I'm gonna play a little game with you. I need rapid fire answers, like tight sentence.
I'm a big talker, though.
Okay. Give me a tight sentence on each of these sectors. Tech,
be very, very selective. Services over hardware.
AI then?
AI, we like AI as a feature. AI is like electricity back in the 1890s. It's big, but the deep seek news worries me because now we're not all NASA. We don't need a big tool. We can get smaller tools. So be selective in tech, especially services over hardware.
Healthcare?
Healthcare, love healthcare. Healthcare, second highest expected earnings growth for 2025, defensive growth. I'm getting older. We're all getting older.
Oh.
We need
You've even got our floor director, Mike, laughing over here. Okay, utilities, and then I'm letting you go.
Utilities. If markets are very uncertain, utilities, yields are rising in utilities. If yields fall in treasuries, people are looking for income and safe income, utilities are the best place to play.
I got a song for you, Gene, Forever Young. We're going to play it in the break.
That's us.